So I've had a lot of people ask me, what do we do? And this comes really from this new CNBC article that just released a new report on November's rent and vacancy numbers. And if you're developing, investing, or operating rental housing right now, it's worth paying attention to. So I'm going to kind of bring some of this article into here. This article stated that the national median rent for apartments fell 1% November from October, and now stands at about $1,367-ish according to Apartment List. It was the fourth consecutive month-over-month decline. Apartment rents are down 1.1% from November 24 and have fallen 5.2% from their peak back in 2022. Now, earlier this year, it appeared that annual growth was on the track to flip positive for the first time since mid-23. However, that rebound stalled out and reversed course during a particularly slow summer, according to Apartment List researchers. So we saw this in our portfolio as well, where Q1, Q2 was strong. We were high on our occupancy, low on our vacancy rates. But as we started to get into summer, we saw a huge move out and we were not getting the people to move back in. Vacancy crept up and we're experiencing that all the way through into this fourth quarter. Now, the historic surge, so I'm going to get back into the CNBC article here. Right here, it states that the historic surge in multifamily construction over the past few years is now pulling back. But a good supply of new units is still coming online at a time where we have a weak demand. So we're causing a lot of this imbalance again. And as I drove around the Arizona and the Phoenix market, I saw building after apartment building being built and coming online, adding more and more to supply to that market. So it's showing as we're driving through these communities and these markets, it's showing exactly what the numbers are showing us, that we're bringing on this supply. And a lot of it is from the multifamily rent during COVID. So we had this huge surge of buying this dirt and building and prepping for this, and they're finally getting these out of the ground. It can take, 3 to 5 years for a project to make its way out of the ground. So back into this article, it really stated that the fall historically has been seen during the biggest slowdown in multifamily rents. But this year, it's even more pronounced. CoStar reported the biggest monthly drop in median rent it had seen in 15 years of tracking this. The primary reason is that more young people are struggling to form new households. And what was really interesting in this article stated that 18 to 34-year-old age groups here, it's up 32.5% of those now are living with family. We're seeing this in our Utah market where people have moved out and moved back into family. So more and more of that age group from 18 to 34 are moving back in with their family. 32.5% are living with family. That's huge. And back to this article, that's the highest it's been in a long time. CoStar's National Director of Multifamily Analytics said, I think it reflects high rental costs that have risen over the years, as well as a tougher job market for young people coming out of college. So we're seeing this right now. So this article is not off. The numbers for November are reflecting this, and it will be interesting to see as we finish out the end of the year here. And as we get into the beginning of next year, Q1 will tell us as we start getting through February and into March, it'll be interesting to see if that demand picks up. So let's get into the article highlights here. There are 3 big things to look at. First, rent growth is cooling nationally. Second, vacancies ticked up as more supply hit the market. And third, the demand hasn't collapsed completely. It's just getting spread across more options. So more supply, not enough people shopping, higher vacancy rates. Now, headlines tend to make this sound like bad news, and some of it is. But from where I'm sitting as an operator right now, this is a phase of the cycle that actually will reward the discipline. And for our portfolio, that discipline is what we are working through. When rent growth slows, The properties that win aren't the ones with the flashiest marketing or the biggest amenities or Class A. They're the ones with that strong internal system. And it really comes down to that resident management. So that fast leasing, transparent communication, response on our maintenance side. And ultimately, what is the resident experience? Are they going to renew with us? Based on how are our teams communicating? Do they want to rent with Max or the operator, or our people that we have on the ground? We have to think and shift the mindset. So in build to rent, specifically in what we are doing, we are seeing that high retention, faster stabilization, because the product is designed around livability, not density. We don't have a ton of stacked multifamily Class A apartments. We have more townhouses and homes and communities. These communities will deliver that value and continue to perform even when the data shows it's softening. Now, not to say we haven't experienced a higher rate of vacancy this year, but it's not what this national average is. This is also where the opportunity will continue to show up. Now, undermanaged assets are going to come on the market. Listen to that. Undermanaged assets are going to come on the market. Stabilized communities with outdated systems are going to underperform. It's just what it's going to be. Operators will not be able to perform during this change in the market. And anyone developing right now needs a property management company involved early so they don't design operational problems into their project. So yes, the CNBC article is right. The numbers are shifting. But what it doesn't say is that this is an operator's market, true operators. The next 18 months won't reward speculation. They'll reward those operators that have execution, that have the systems, that have the relationships with the residents, and are creating an environment where they'll stay. What are you going to do when you're heading into 26 here? Think about your plan. Think about your teams. We're already doing it. We are A/B testing and seeing how our renewals are going to affect next year. Retention in 26 is the key. It's not finding new renters out there because it is hurting out there. So having an operator that is prepared, that is testing, that is working on it right now is those that are going to survive this next 18 months. After reviewing that new CNBC report on November rent and vacancy trends, one thing is obvious. 2026 will be the year solid operators, which means your investors will win. Now, it's not the headlines. So the key takeaways here are rent growth has flattened nationally, that 1.1%. So we're seeing it just continue to come down. I don't see that stopping. Vacancy has risen faster than expected, and we saw that. And a lot of operators got stuck. Supply deliveries will remain elevated, but for a short period of time. Demand is steadily just spreading across more units. For investors and operators, this means four things. Your underwriting when investing needs to be tight. Number two, retention becomes a major performance driver. That is what we are doing right now. Our teams are working on that retention, are working on that customer service, are working for our residents to keep them in our units and continuing to perform. Number three, the BTR communities with strong management will continue to outperform any of those multifamily and Class A properties. It's a given. Number four, the submarket level data matters more than these national averages. We are digging into each submarket. Salt Lake City, boom, big. Utah County, big. What about these little submarkets in between? Each one has its own ability to perform and have different data points. So we have to shift to the submarket levels. So our focus moving forward is it's simple. It's better systems, it's faster, better experiences. What are we doing for our residents? How are we keeping them there? We are going to create an experience for our residents so that they want to renew with the people the experience that they are experiencing in their own communities that they're living in. How do we help them stay while we're going through this entire market shift? So what do the updated numbers mean to your business? Are you preparing? Are your teams analyzing and working through it right now? Because 2026 is going to make and break those. And those that are good operators, that are working through these now while they're seeing these numbers, will win. I'd love to see your comments below. Let's talk about this. Let's engage into it. Let's prepare for 2026.